The South African banking cartel did it again. The question is, did the South African banks keep your loan rates high for 25 years? Let's break this down. Repo rate versus prime lending rate, and what is the difference? If you have bond or any loan, this is literally money out of your pocket. Repo rate is the interest rate that South African Reserve Bank charges on commercial banks when they borrow money. Then banks add a fixed margin of 3.50% on top of that, which is what they use to price loans for you, consumers, and businesses. This system has been in place since 2001. Right now, the repo rate is roughly at 6.75%, while the prime is roughly at 10.25%. That means most bank loans start at a much higher baseline, even before your credit score or risk is factored in. Here is what gets controversial. The Competition Commission is now investigating whether banks colluded to keep this prime spread at 350 basis points, effectively making cost of credit artificially high for over 25 years. And this could be unlawful under South African competition law. Banks and banking associations are adamant that this is not price fixing. They argue that spread is just a benchmark tied to monetary policy, and banks still compete by offering individuals offering rates above or below prime. But critics call this a cartel-like practice that hurts ordinary borrowers. If wrongdoing is found, the competition tribunal could fine banks or mandate changes, but it is still unclear whether that would retroactively lower rates or give refund to past interest. For you, this is real money because lower borrowing costs is equal to bigger savings on your home loan, car finance, business loan, and potentially thousands of rents every year. Follow for more updates and if banks should not be price fixing essential credit. Share this video with as many people as possible to keep the conversation going. Cheers.